This is Smail, and today we're going to talk all about money and commission checks and how you get paid and business accounts and taxes, everything working from elementary to advanced about what we should be doing with our monies as real estate agents. And the reason why I feel like it was an important topic is about a month ago, I had a conversation with an agent from a different state, and she had asked a question about how we should be paid as realtors, and a lot of people piped in with different answers. And I was just reading people's answers. It felt like a lot of people did not know how they were getting paid. The advice that they were given, I don't think they were retelling with much inaccuracy. So I called this agent, and she revealed to me in a conversation, she said, I have $150,000 in my business account. So my commissions got paid into my business account, but I'm afraid to put it into my personal account and spend it because I don't want to pay taxes on it. And at that moment, I realized there are misconceptions, and I just want to help clear some of those things up. So from basic to advanced, we're going to talk all about monies. Let's just start at the very beginning. I want to become a real estate agent. The first thing you will want to do is open up a checking account at your bank, just totally for your business. You already have other checkings and savings accounts personally. To have a business, to run it like a business with the confidence and success of a business, you need a business account. You will open up that business account and you'll take, let's call it $5,000 of your hard-earned money you've earned from a different job or different savings, and you put it in this business account because you do need money, to run a business for even licensing and tests and things early on. You open up a business account, a checking account, you put $5,000, let's use that number, into that account. I want you to know that $5,000 you've already paid taxes on. You earned it from another job, a series of paychecks accumulating the $5,000. You pay taxes on that $5,000, so that's your money. You put it into your business account. You'll want to kind of keep note of that $5,000 you started with was not business income that then should be taxed again. It's your money you put in the account because you need money to spend. Then you'll start getting commission checks, and you'll start being paid as you sell houses, of course. So this is really, really important for everyone to understand. Your income for the year that you're responsible to pay taxes on is every single dollar you earn added on top of each other, every single commission check stacked on top of one another. Whatever that grand total is of every commission check is called your income, and you will be paying taxes on your income. I know that sounds totally rudimentary. This agent I'd had a conversation with was getting paid all of these commission checks, but she specifically thought, well, I'm not going to take any of that money and do an online transfer or have a check written to me that I'm using on the personal side of my life, because then I don't have to pay taxes. That is not how it works. Because you got paid the checks and all the checks added up, you are responsible to pay taxes on that amount of money. Whether you spend it or save it or transfer it or manage it or maintain it in your business account, it's income, so you will pay taxes on that. But let's talk about what I do when I get paid, and so how I pay myself from every commission check. This is just the way I do it. I'm sure there are some other great best practices, but this methodology of how I break out every commission check has just been a system I followed since the very beginning, when there were 6 commission checks that came in the first year, and then the numbers of commission checks will build from there. I'm going to pretend I received a $5,000 commission check just so that we can use the mathematics there. Remember, I started my business account with my own $5,000, so that sits in there, and I have my first commission check. So now I have another $5,000 goes from the company into my business account. So now it's income, I'll pay taxes on it. But how do I get to use it, like the fun part of getting paid so I have money to spend? The first thing I will do with that $5,000 check is I will save for taxes, because as we know, as a 1099 instead of an employee with the W-2, the company does not take the taxes out for us and give us what's left that we get to have. They give us all of it, and we are responsible for paying the taxes at the end of the year when they come due, because taxes have not been paid yet. So that's my first obligation, is to make sure I have more than enough money to pay my taxes. I just never want to get into a scenario where I owe more money than I've saved. I never want to live under that type of stress, so I save for taxes right away. I take 25% off the top of every check and I put that into a separate account. You can do a different business checking account, savings account, an investment account that's low risk. I just have to take 25% of that $5,000 check and stick it somewhere. I just have to put it somewhere. So 25% of a $5,000 check is $1,250. Comes right off the top. It's 25%, and that goes in a separate account, and I never spend it or touch it. It just sits there until the end of the year or into the next year when the taxes are going to be paid. I have that set aside. So 25% for taxes. I will tell you, even for me, that is over saving on taxes. I could thin it down if I wanted to, but I do not. Depends on the tax bracket that you're in. You might save 25% of every commission check. When you do your taxes, at the end of the year and the next year, you may actually only be in a 21% tax bracket. Let's say 21% of that you pay in taxes. Well, you've saved 25% of a whole bunch of checks. I think it's kind of nice because when you finally do pay your taxes, you've saved this much, which is 25% of every commission check added up, and your taxable obligation was only 21%. You sort of have a built-in savings account, or you have some extra money that's revealed to you at the end, and to me that's kind of a nice surprise, so I like to do it that way. The other way I know I'm over saving on taxes is not just 25%, but I take that off the very top of the commission before I've spent any of that money. Well, if you add up every commission check throughout the year, and let's call that $80,000 is what you've earned, and you've saved 25% of that, 25% of $80,000 would be $20,000 taxable obligation. Well, of the 80 you made, you had business expenses that came off of that. We'll talk about those expenses in just a little bit. Well, let's say you've spent $20,000 in expenses, so now your adjusted income is actually $60,000, not $80,000. And then of that $60,000, maybe you're only paying 20% of that towards your taxes. So you save 25% of $80,000, which is $20,000 set aside. Well, really you owe taxes of whatever 20% of $60,000 is, which is $12,000 if I'm doing the math correctly. So you save 20, you actually owe 12. I think it's nice when the year finally goes through and you pay the taxes to have $8,000 set aside that you can keep, to have put you ahead saving the taxes for following years, or it's just your money. You've already been paid all the taxes you need to. To me, it's kind of like a bonus to take it to make a big house payment or a house project. So that's the other way I'm okay. I know I'm over saving on the taxes because I save off the top and a greater percentage of what it's really going to be. So in two ways I'm ahead. I'm living on less throughout the year because I'm pushing that money aside, but I get it back at the end, and to me that's well worth it. The next thing I'll do is take 15% of the commission check, so the $5,000 commission check, 15%, $750, and that is for retirement contributions. As we all know, as a 1099, an independent contractor, we don't have any benefits. There's no taxable or retirement contributions matched by the company. You could choose to do no saving for retirement, though I don't recommend that. I think you should be saving for retirement. So I'll do 15%. I think that's a good standard. So the $5,000, 15%, $750. The way you invest that or how you make retirement contributions is up to you and your financial advisor, and that's maybe too many niggly-naggly details to get into today of IRAs and Roth IRAs and 401k and a solo 401k. I will defer that to you and your financial advisor to have a conversation about what is the best way to invest those retirement dollars. For me, I think it's more about the behavior. It's a greater, the majority of retirement activities is a behavior, which is not spending the money and contributing it, and a small piece of it is the mathematics and how the monies work and the interest they earn, but that's a financial advisor's territory. So I just want to always have the discipline to give up 15% of my income to retirement, and I've already given 25% towards taxes. So of that $5,000 commission check, 15% and 25% have gone away, that's 40%. There is 60% remaining. Well, 60% of $5,000 is $3,000, so 60%. The way I split that up is I'll take 30%, so that's $1,500 of the $5,000. $1,500, and now that becomes our own money. We transfer it into our personal checking account or savings account, and we use that like income. We can use it towards savings, for a house payment, more house payment, just buy our groceries. That is our monies. We're only living off of, or we're trying to only live off of 30% of every commission check. So $5,000 check, $1,500, that's the money we get to live on. Obviously, if you only sell a handful of houses a year and take 30% of that, like that's not a lot to live off of, but we're real disciplined from the beginning to do it that way. The other 30% of the $5,000, or the $1,500, I know this is a lot of math, is something I maintain in my business account. So taxes or retirement go away, what's left is 60%. We divide that in half. Half we get personally for groceries and fun, whatever we want. The other half I maintain in my business account. So go back to the very, very beginning, I opened up my business checking account. I put my own $5,000 in there, which was not income into my business. I put the money in there myself, it's my own contribution. Got the $5,000 commission check that comes in, things get doled out. I leave $1,500 in the account, because that's the 30% of the $5,000 new commission check. Now my business account has $6,500. So I just run my business off of, and it's actually far less than 30% of my commission checks. And here's why. In addition to transferring the 30% of the commission checks to us personally, and we maintain some in our business account, we have a threshold we've determined we want to always maintain in that business account. It used to be $10,000. Now it's $15,000 and maybe $20,000, because there's an assistant who I pay monthly whether I'm selling real estate or not. Someone else's income depends on me having the money to pay them. And so I always want to honor that commitment first, so I maintain more in my business account. But once we get over $20,000 in the business account, we take anything above the $20,000 and we transfer it into our personal lives, into our savings account or checking account. So sometimes the account is sitting with $18,000 in my business account, and you might get 3 or 4 commission checks over a 1 or 2 week period, and maybe that's another $15,000 of commissions that come in. Well, from that, if we do the math from the whole total, I'll take 25% of $15,000, and that's the taxes, and 15% of that $15,000 to retirement. I'll take 30% of that $15,000 and go personal, and then the rest is in my account. Well, because the checks, the total of those commission checks that came in and keeping 30% of that, it now exceeds $20,000 in my business account. So after making all the transfers we need to, we assess what's in the business account, which is now greater than $20,000. We take that excess and we put that into our personal lives. And for a long time, we actually used that to make more regular or higher house payments. We made a regular payment when it was due to the bank. And then we just said all the extra monies that exceed the 30% in our business account, and once it exceeds $20,000, we'll take that and we'll make bigger house payments. So sometimes if the commission checks all come in a lot in a month, we might make a $5,000 or $7,000 house payment, which was our goal, to be real aggressive on paying off a mortgage. So that's the way we get paid and how we manage the commission checks. I know some agents will get paid the same thing every single month, and they might have just such excess in their business account at all times that if they agree to pay themselves $5,000 or $7,000, they certainly can, because that money comes out on the first of the month to them, and the business account balance comes down, but there's enough in there, and that is one way to do it. I just wanted to get paid every single time I received a commission check. So that might be 30 paychecks a year, that might be 100 paychecks a year. We got paid ourselves 30% of those checks every single time they came in, and of course the excess over $20,000 in the business account. Let's talk now about managing and tracking your expenses. Because your business does have operating costs, it's going to and it should, and that's the way it's supposed to be, but you want to maintain those and track those. And here's a real important reason. Remember when I said your income you pay taxes on is every single commission check added up, whether it's shifted in or out of personal accounts, you made the monies, you add the checks up throughout the year, that is your income for the whole year, you pay taxes on it. But all legitimate business expenses, and we'll talk about what that means, that lowers your income. So I use the example, you've made $80,000 in commission checks and you've saved for taxes for all of that in the 25%. You spent $20,000 on Popeyes and pre-inspections and Matterport tours, photographs, I mean all the expenses you need to run your business. $20,000 is what your expenses were, so now your income is actually $60,000, and that's what you are taxed on. Of course, you way overstay for that, so you're ahead of the game. You can only deduct those business expenses, one, if you know what they are, and they are legitimate business expenses. I think some agents early on, or the ones that get into trouble, doesn't have to be early on, are the people who don't track their expenses. So every dollar they spend, if they forget they've spent it and haven't recorded it, well, now they can't lower their income by that dollar that they spent, which is what you should be doing. Or they start to claim things that they purchased as business expenses when they were not. And I don't think that's the right way to do it. And if the IRS knew that's what was going on, they of course would not be very happy to. So let's first talk about tracking the business expenses. So most people will have a business credit card, or your business account have a debit card, and you're using that every time you make a purchase or have an expense for your business. The commingling of funds makes things really, really complicated and can get you in hot water. So you have a personal life and personal debit cards or credit cards or cash, so that your life exists personally. And then anytime you buy things for your business or pay for photographs, pre-inspection, that would come directly from the debit card or credit card that is, of course, attached to your business. So that just makes the tracking easy. In the best practices way, you have a receipt for everything you've done. You've saved all your receipts. And you could go to your credit card statement if you always use your credit card and see exactly what you spent. So you have your credit card, you have your receipts, and then of course from your business account and your bank account, you can see where you paid off your credit card, the $1,000 you had spent over the last month, which matches up to the $1,000 of expenses on your credit card, and you have $1,000 of receipts. That's the best practices way to do it, because if at some point the IRS wants to audit you, you need to prove what your expenses were, and to be able to pull up the receipts to match your credit card statements is important. The credit card statements, it'll tell you went to Lowe's, but it doesn't tell you what you bought. It just says you spent $100 at Lowe's, which you said was a business expense. Well, if the IRS gets real picky, they might say, well, what did you buy at Lowe's for $100, and were those all legitimate business expenses? If you have your receipt that shows I bought $100 in lawn and leaf bags, which I gave out as Popeyes, well, those could be business expenses. But if you actually spent $20 on lawn and leaf bags for Popeyes and $80 on a tool for yourself that is purely for your personal enjoyment in your personal life, well, you should not have deducted or claimed $100 of business expense. Your receipt would prove all $100 from Lowe's were for a business expense. So that's why the receipts are important to back up what you've done and in case you get audited. The credit card statement, it's probably easier to be able to flip through and say I only made business expenses on my business credit card, so I know exactly what I spent this month and throughout the year. You can tell your accountant, here's what my business expenses were. I use a spreadsheet. It's a very manual process. I manually enter every purchase that I made or expense that I had. And I started that way back at the beginning when I had sold 6 houses the first year and probably only had 30 expenses. I mean, like literal expenses, because I was not doing, the real estate didn't generate a whole lot of expenses. I mostly did it manually because I just wanted to know exactly what was going on. And I just, as expenses grew and sales grew, I never have flipped to something that is way more technologically based, and I'm sure it would be more efficient in my life. I just kind of like the old school manual way of, if I've spent something, I have the receipt in my pocket, I keep it, I'll go back to my computer and I have a spreadsheet and I will enter Lowe's lawn and leaf bags, $100 and the date. So it's a very manual process, but that's okay. It gives me a pretty good grasp on everything that I am spending. But I would encourage you need to have some way of tracking those expenses. If I spend $100 at Lowe's and forgot to record it, so then I forgot in 12 months from now to tell the accountant about it, well then I don't get to claim those $100 as an expense, so I'm actually taxed on $100 instead of lowering my taxes on that $100 because I earned it, but then I use it on my business. So it's almost like, so I didn't earn it, or at least I'm not taxed on it. So please have a method for tracking your expenses. I know there's technologies that do it. I just like a manual spreadsheet. When I do track those expenses, I do break them down by category. And the categories are things that my accountant we've discussed, because it's not helpful to say, here's $30,000 of expenses, here you go, because when they file your taxes, they have to sort of break out your expenses into certain categories, like advertising and licensing fees and signs and lock boxes and trainings and a cell phone and leases. And so there's all these categories. So I, on my spreadsheet, have all those categories broken out. I will tell you, advertising is sort of a catch-all that ends up being my biggest expense because of Popeyes and photographs and the lawn and leaf bags and whatever else. So I have more advertising expenses than everything. I have very little like office supplies. I'm not replacing my laptops. I'm not buying copy machines. So that sometimes has almost no expenses throughout the year. But I'll label my receipt, and then I'll group those in an envelope together, and then I'll put that all into the spreadsheet. I do want to talk about your vehicle costs and mileage specifically, because there's oftentimes a misunderstanding about that. You can claim your vehicle expenses. There's two different ways to do it, but you can only do one or the other. So one way is to track all the miles you drive related to your business, the business miles, and let's say that's 20,000 miles in a year of maybe 30,000 miles you drove, because 10,000 was vacations and other things, but $20,000 of business miles, you tell that to your accountant, and then they will apply a formula which changes each year. The government will change that. The amount you can deduct per mile, which I think right now is like 57 cents a mile. So you can do it that way. You drove 20,000 miles times 57 cents a mile. Let's just say that's $13,000. So you can deduct that from your income. Or you can keep track of all your vehicle expenses. So that's gas, oil changes, detailing, new tires, repair costs. It depends. The way you do it depends on which is going to make you the most, or to be the most helpful to you. I own my car. I'm not making payments on my car. It's a fine car and it doesn't have a lot of repair costs. I likely will not put $13,000 of expenses into my car in a year to cost more than what I will get for driving 20,000 miles times 57 cents a mile. If you had a really high car payment and maybe you were doing customizations to your car and it needed a lot of repairs, you might end up spending $16,000 just on your car in a year. Well, that would be better than doing your mileage. So I will use my business account to fill up my car with gas every single time. I don't keep that receipt. I just throw it away. I pay for my oil changes. I use my business account to pay for car costs, but I don't have in my spreadsheet what I spend on gas and oil changes, because I know it will not be more than the miles that I will deduct. There was one year when I had a lot of car expenses. I had to put a new engine in my car entirely. That was $6,000. So in that particular year, I had more vehicle costs than mileage costs. So we did it that one way, but normally I'm tracking my mileage. And there's a lot of apps that do that, like just your phone literally knows where you're going, and then you get to swipe right or left to classify it as business or personal. So that makes it pretty easy. Also, as you get into it, your mileage each year is kind of the same. if you're doing the same amount of real estate and doing it the same amount of days a week and going to the same locations, Millard, Papillion, Bennington, I mean, just working in the metro, it ends up being pretty similar each year. But best practice is to track the mileage every single year in case the IRS asks. You can prove to them with either a journal or on paper, a spreadsheet, a log, or digitally that you really did put on that many miles on your vehicle for business. I do want to spend just a little bit of time talking about the legitimacy of business expenses, mostly because I want to keep you out of trouble. It's okay to have business expenses, and you should have those. It lowers your income. That's all really good things. You can get into trouble when you are buying things from your business account that are not business expenses, but you are telling the IRS they are business expenses. So let me try to be real clear on that. Not everything you buy from your business account has to be a business expense, but everything you claim to have bought that's a business expense really should be a business expense. So let me try to expand on that. When it's Valentine's Day and I want to buy my wife flowers as a surprise, well, our regular checking account and debit cards, she would see I went to a store and I bought something, and so then the surprise is ruined. I will go to a florist and I will buy flowers for my wife, and I will use my business credit card because she doesn't manage that as closely as she does her personal expenses. Then I can deliver the flowers to her, and so then I've maintained the surprise. I spent $40 from my business account. That is okay, but I am not keeping track of that expense. It's not going into my advertising category. I'm not keeping the receipt, and I'm not telling my accountant and the IRS I had a $40 business expense on this date, and it was for flowers for my wife. So that's an important distinction, is you can buy anything you want to out of your business account, and you're not in trouble for that, but you are in trouble if you buy things that are not business expenses from that account and you tell the IRS they are. As a best practices, so you never get confused and forget to call something an expense, or you called something an expense that wasn't, that's why you have not a commingling of funds. You have a personal life and a professional life. When I do it and I mix what the purchase is going to be, I know to just throw the receipt away and never think of it as a business expense. So that's really important. That can get me into trouble, or could get an agent into trouble, the more of those things that you have, and when you start telling the IRS they are business expenses. I'm sure some realtors have gotten in huge trouble for when they remodel their house and they spend $20,000 on new furniture, and they buy it from their business account, and then they tell the IRS it's a business expense and it was staging furniture. If you ever get caught and then you find out all those things you bought sit happily in your own personal home and have never visited a listing, that's when you get into really hot water. Or you send out a house cleaner to pay a house cleaner as a gift for a client. It's $300. That's a business expense. You pay them the $300 to come clean your own house, not a business expense. Same with lawn mowing services and things. To pay for someone else's property, a client for a listing, business expense, to pay out of that account is okay. You can pay it out of your account, business account, the house cleaner, but you should not tell the IRS that on this date the $300 to the house cleaner was a business expense. So I hope I'm not being too confusing on that. I just think there's a real important distinction between where the money comes from and what it's for, and ultimately what are you telling the IRS it was, and you're trying to lower your income by calling it a business expense. The last thing I want to spend just a little bit of time talking about is LLCs and PCs and S Corps and C Corps, kind of some structures you can set up for your business that are more tax efficient. I am not an accountant, so this is not legal accounting advice, but I do try to be a good student of the industry and the options, and certainly understanding the things that I am doing. So I'll just try to give a sort of a high level overview about some of these structures you can put in place. If you have no structures at all, depending on what your income levels are, you bear the fullest burden of taxes. They take the entirety of your income minus your expenses that hopefully you've tracked, and then you pay the full burden of the taxes on that. You have income tax, and then you have self-employment tax. And so there's kind of like, you're getting taxed, let's call it, they're not both double, but you're getting hit 2 times on every dollar that you made. If you have some of these other structures in place, like I have a professional corporation, which is an S Corp, and so because I have that as an S Corp, I'm an employee of the corporation instead of just being like a sole proprietor. And so basically the spirit of that is every commission check that I make and the taxable obligation it creates, I'm not being hit double on all the income. I'm paying the full amount of the income tax on all the dollars, so the income taxes on every commission check minus expenses. Here's what I'm left at, and so I pay income tax on that. But I am not paying the full burden of the self-employment tax on all of those dollars, which is about a 15% tax. So with an S Corp, you would establish a reasonable wage. And so let's say your reasonable wage is $40,000. So that's just it's kind of just recorded on paper that of all the incomes you get and the money's transferred into your account, of all of that money, $40,000 is your reasonable wage. That's what your corporation paid you. So if your income was $100,000, that's what you actually got into your personal lives after expenses and things. So there's your income of that $100,000. Instead of paying income tax on all of it and self-employment tax on all of it, you only pay the self-employment tax on the reasonable wage, where that's the $40,000 amount. So that's sort of the double burden of taxes is on a lesser amount, $40,000, and the $60,000, which is your legitimate income classified as draws, you're only paying the income tax on. So without the structure, you pay double taxes on $100,000. Now you're paying double taxes on a smaller portion, which is good, and then on the larger portion of your income, you're only paying the single set of taxes. So I hope that just makes sense, kind of the spirit of that. I'm not an accountant, even trying to be a good student of that. I don't always explain it with the most grace, but I would encourage you to talk to your accountant as your income goes up. I don't know the exact dollar figure of when it makes more sense to have one of these structures in place. If it's an income of $20,000 a year, if that's what the commission checks were, then you probably wouldn't want to take on the headache and nuisance and the cost involved with setting up an S Corp. And I've heard the break is kind of, if it's about $80,000 in commission checks, then you would want to have the structure in place, because that's when it starts to pay off. But please ask an accountant about that. I sincerely hope that was helpful. I know that it's just a ton of numbers, back and forth, but I hope the concepts stick, at least about how to break out your commission checks so you know how you are paying yourself. You can make a wonderfully fine amount of money in real estate, but I want you to know where the money's coming from and what it is and what you have to spend. And once you have a good grasp of it, one, I think that's a good signifier of running a good business. But then you can start making some plans for paying off your house or saving for college. I mean, your money, which can be in great amounts in real estate, is just far more useful when you know where it is and what you're spending it on. So I'm always happy to visit more about this. So absolutely please call if you have other questions. Happy to sit down and talk about it more, but I just hope for today those concepts at least were helpful for getting things started.